Good morning, folks. Pretty chilled out trading conditions in the market this weekend after a fairly hectic end to the week. We do have, unfortunately, a slightly worsening macro situation, slightly more uncertainty there, but the liquidity metrics in the market do seem to be balancing out, which is good. So let's jump in straight away and take a look at some prices. You can see Bitcoin currently trading at $109,900. You can see I am still very happily in my 1 BTC leverage long position. This is a 20x leverage position with an average entry price of $113,277. I started getting into this trade. I started getting long on limit orders during that massive down day we had a couple of weeks ago, that massive historic $19 billion liquidation event. Got it a little bit higher than I would have liked to have done, but I have slowly averaged down into that position as we hold in these depressed prices. Every time we call off a little bit, I start looking for strategic entries to add into that. So I brought my average pricing down to about $113,277. I don't think I have completed that process just yet. I do think it's still very possible, and in fact even likely, that we see further downside from here before an eventual move up, before we eventually find that liquidity. If you got yesterday's video, you will know we were looking at the volume profile from the initial move up, right? The initial low that we put in after this big down day to current pricing, and we deduced that there was a point of control. There was the point of most volume conducted at about $108,000. And we are today slowly moving up, okay? So from the lows put in yesterday, we're currently sitting up about 3.38% here on the Coinbase spot chart. But conditions have been a lot less volatile than the end of last week. Okay, we did come through and we liquidated a lot of leverage longs out of the market again towards the end of last week, something in the region of $600 million to $800 million worth to be exact. But over the last 24 hours or so, that has been much more chilled out. You can see over the last 24 hours, $111 million worth of longs liquidated, but also $108 million worth of shorts liquidated. So the forces of liquidation in the market are pretty balanced where we are right now. And if we take a look at the liquidation map here on CoinGlass, you can see pretty much balanced on the 1 day time frame, with maybe a slight bias right now to the long side. Also, we are much closer to some of that long liquidation risk. You can see actually a level that I was looking at to the downside here, $108,600, right? Just the local low that we put in earlier this morning. That corresponds to about $150 million worth of long liquidation risk in the market. And a little bit further up the book, I would probably look at reference points here, 108K, in fact, $108,300 worth about $350 million worth of long liquidations. But bear in mind, as the market ebbs and flows, particularly when there's overall balance on both sides, this will tend to shift, okay? As people get out of those leverage positions on either side of the market, they don't necessarily have to be liquidated out of those positions. They can emotionally capitulate or just choose to get out of that position ahead of time. But markets are depressed, okay? And I think the main reason for this, if we take a look at the S&P as well, by the way, down on the day, the main reason for this is the Fed Watch prediction for a further 25 basis point rate cut at the next December meeting has reduced even further from yesterday. Okay, so we're now sitting at 63% chance of another 25 basis point rate cut in December, and that is down from about 70% yesterday. Although we haven't had any particularly big news on the economic calendar over the last 24 hours, I think what has happened is the market is absorbing Fed Chair Powell's comments after that meeting, where he was talking about the fact that another 25 basis point rate cut for December was not a foregone conclusion. Okay, in fact, he said it was far from that. I think the market is starting to absorb that data, or continuing to absorb that data, and fully act upon that, right, in the predictions. Also important to note two other details, right? Part of the way this possibility or this probability is calculated is to do with the futures market. Okay, so there might well be some rebalancing going on there. And in fact, when futures traders flatten out their positions or hedge their positions towards neutral based on data that should be coming out, like CPI. As they rebalance that actually impacts the implied probability for further rate cuts, because that is how these rate cuts probabilities are calculated. Also, we know that the government shutdown is affecting these rate cut decisions. And the way that that is tied in, essentially, we know it's very unlikely that we're going to get a CPI data release for October, which should usually come out mid-November. Now, of course, that CPI data is key for the Fed understanding how inflation is shaping up, and that is key to the Fed deciding on further rate cuts. So the risk there is basically, if we're missing a data point for October, if we're missing that release in November, then that brings into question what's going to happen the next time the data is released, right? If you think of a chart and you've got regular data points, if you miss one, the odds of the next one being predictable are much less, okay? So there's more chance of a surprise the next time we do get CPI data. And of course, markets don't like risk, okay? Markets don't like unpredictability. And if we're missing a data point on the CPI, the odds increase that we are surprised once that data is finally released. And so it is harder to be certain that we're going to see further rate cuts. I hope I'm explaining that in a way that is easily digestible. But part of the reason why the Fed doesn't have data to go on is from the ongoing government shutdown in the US. So you can see here, CBS News, government shutdown likely to extend to next week as the Senate adjourns with no breakthrough. And this was on the 30th of October, so just a couple of days ago. The Senate adjourned on Thursday and won't meet again until Monday. That is 2 days from now at the time of recording, extending the government shutdown until at least its 34th day, which would match actually the longest funding lapse in US history. Senators continue to express cautious optimism about bipartisan talks over reopening the government and passing longer-term appropriations bills, but Thursday saw no apparent breakthroughs, and the upper chamber did not vote on the House-passed continuing resolution. So in conclusion, chances of another 25 basis point rate cut are down about 10% from yesterday. There's actually a 37% chance now, here quoted by FedWatch, that we see no rate cut in December. That is further spurred on by Fed Chair Powell's comments at the end of the last FOMC meeting yesterday. And part of this is the continuing government shutdown and the fact that we're not going to see CPI data for October released in November when it should be, which means it is even more uncertain on when the Fed is going to take good quality data to make these rate cut decisions about inflation, which is obviously a key factor in how they're managing rate cuts. We like rate cuts in risk assets. Crypto is a risk asset because when money becomes cheaper, when the base rate is cut, it means that investors are more likely to take their money out of yield-bearing assets like bonds and put that money into not yield-bearing assets, risk assets like stocks and like crypto. So S&P down, gold still down, which is good for our gold-Bitcoin correlation, and Bitcoin pretty low volatility today, still pretty fairly depressed. But once again, I do like the way that liquidation in the market is balanced out. Although, that being said, there is fairly high liquidation risk on both sides of the market on the daily chart. Once again, if we zoom that out, this risk is skewed massively to the upside, which is good if you are a bull in this market, because it means when prices do finally start coming up, we might well start liquidating some of these shorts, and that means forced buying onto the market and essentially demand shock, which will further spur on that movement to the upside. But as always, that's just what I'm looking at, just what I'm interested in. I hope that brings some clarity, some new perspective to you, and I hope at the very least you found it entertaining. Please don't consider anything I say financial advice, purely for entertainment purposes. But thank you so much for watching. Catch you in the next one. Bye.